In times of economic uncertainty, are you wondering whether now is the right moment to buy stocks? Experts say the answer isn't clear-cut, but savvy strategies can tilt the balance in your favor. While geopolitical tensions and tariff fears may spook markets, history and data show that smart investors often thrive by staying calm, building diversified portfolios, and focusing on quality names. Retail investors are coming off one of the busiest quarters in recent memory, pumping billions into equities, even as volatility remains elevated. Wall Street pros advise trimming euphoria-driven tech bets, pivoting instead to defensive plays like healthcare, infrastructure, energy, and financials. So if you're asking, is now a smart time to buy? The consensus, yes, but with discipline, diversification, and a long-term mindset. Let's explore how to act wisely when uncertainty reigns. Today we will talk about, is this the right time to buy stocks? Expert tips during economic uncertainty. So before we start, make sure to hit the like button and subscribe to my channel. 1. Market uncertainty and investor fear. Every few years, financial markets enter a period of deep uncertainty. A perfect storm made up of economic slowdowns, geopolitical tensions, and policy upheavals. Naturally, when the future feels shaky, many investors become nervous about putting their hard-earned cash into stocks. Fear dominates the narrative. People rush to withdraw their funds, causing prices to drop and creating dramatic volatility. But for a well-informed, patient investor, these moments can present some of the greatest opportunities. Legendary investor Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." There's a kernel of profound truth in this observation. Market downturns often reflect short-term panic rather than permanent weakness in a company's fundamentals. So the key question isn't whether you should buy stocks during economic uncertainty. It's how to separate the temporary chaos from lasting value. 2. Market volatility explained. Why uncertainty happens. Before we can determine whether it's the right time to buy, we need to appreciate what drives volatility in the first place. Uncertainty typically sparks from a combination of factors: wars, recessions, policy decisions, health emergencies, and shifting consumer trends, all of which undermine confidence in future earnings. The result is wild price fluctuations and a dramatic rise in the fear index, like the CBOT Volatility Index or VIX. Importantly, this kind of volatility is not a reflection of companies' true worth. It's a reflection of market sentiment and psychology. Fear and panic undermine rational pricing, causing strong companies to be unfairly discounted alongside weak ones. To a patient, well-informed investor, this phenomenon can be a powerful opportunity to buy valuable assets at a deep discount, a key principle advocated by many successful fund managers and financial innovators. 3. Historical perspective. Market recovery after uncertainty. Looking back through history, nearly all periods of economic uncertainty have eventually resolved, and markets have rebounded to new heights. The 2008 financial crisis, for all its chaos, was a remarkable buying opportunity for those brave enough to enter when prices fell. Between its low in March 2009 and its peak in February 2020, the S&P 500 multiplied more than 4 times. The COVID-19 shock in March 2020 seemed catastrophic at the moment. Businesses were closing, unemployment skyrocketed, and the future seemed profoundly unsure. Yet within months, markets recovered and soared to all-time highs. The key takeaway from these historical episodes is not to panic, but to view uncertainty as a temporary phenomenon against a backdrop of long-term growth. The businesses that were strong and adaptable before the crisis remained strong afterwards, and patient investors were rewarded. 4. Benefit of dollar-cost averaging during uncertainty. Instead of trying to time the bottom, a nearly impossible feat, many financial experts recommend employing a dollar-cost averaging (DCA) strategy during periods of uncertainty. That means investing a fixed amount at regular intervals regardless of the current price. Doing this lets you buy more shares when prices are low and fewer when prices are high, averaging your cost basis over time. It removes the need to predict market movements and dampens the impact of volatility on your portfolio. Furthermore, this discipline prevents impulsive decisions driven by fear and media headlines. Instead of trying to outperform the market in a crisis, which is nearly impossible, you allow your portfolio to grow alongside the eventual recovery. The result over a long period is often a strong return with less stress and a more manageable risk profile. 5. Sector-specific opportunities. Where to look during uncertainty. Not all sectors suffer equally during economic downturns. Some are more resilient, and some may even outperform. For example, consumer staples, utilities, and healthcare companies typically enjoy stable profits, regardless of the economic climate, making them defensive picks for portfolios. Furthermore, technology companies with strong balance sheets and adaptable business models often emerge from downturns in a more dominant market position. Certain sectors, like energy, financial services, and real estate, may be more prone to volatility, but when carefully researched, they can present opportunities for significant gains once recovery sets in. The key is to be discriminating. Instead of buying indiscriminately, focus on companies with strong fundamentals, manageable debt, strong cash flow, and a durable competitive advantage. Doing your homework here lets you separate companies suffering from temporary weakness from those in permanent trouble. 6. Expert tips: how to approach your investments. Here are a few expert strategies to guide you through buying stocks during uncertain periods. Stay calm and rational. Fear and panic often lead to impulsive decisions. Stick to your plan and avoid selling into weakness. Analyze company fundamentals. Look at balance sheets, cash flows, and earnings reports to find companies that can weather a downturn. Consider your time horizon. If you're investing for the long term, 5 to 10 years or more, short-term fluctuations become less significant. Diversify your portfolio. Reduce risk by spreading your investment across sectors, asset classes, and geographies. Keep some cash. Having a cash reserve lets you buy into opportunities when prices drop further. Don't try to time the market. The best investors know it's nearly impossible to buy at the absolute bottom. Consistent, disciplined buying typically performs well in the long run. 7. Risk considerations. Be aware of your risk tolerance. Before making any decisions, it's crucial to honestly assess your own risk tolerance. Are you comfortable seeing your portfolio fluctuate by 20% or more in a short period? If not, you might consider adding more stable assets, such as bonds or cash equivalents, to dampen volatility. Furthermore, it's wise to maintain an emergency fund, typically 3 to 6 months' worth of expenses, and avoid investing money you might need immediately. Market downturns can last longer than expected, and you don't want to be forced to sell at a loss just to meet your financial obligations. The key is to align your portfolio with your financial goals, time horizon, and ability to absorb losses. Conservative investors might tilt toward dividend-paying stocks, while more aggressive ones might pursue growth stocks with strong future potential. Whatever your approach, staying within your risk tolerance is essential for peace of mind and discipline. 8. Making your move during uncertainty. So, is this the right time to buy stocks during economic uncertainty? The answer depends on your goals, risk tolerance, and discipline. If you have a long time horizon and a well-diversified portfolio, buying during downturns can be a powerful way to maximize future profits. Fear drives prices below their true value. Patient, well-informed investors can take advantage of these discounts and outperform in the long run. Nonetheless, it's crucial to do your homework, avoid impulsive decisions, and align your choices with a clear financial plan. Market cycles come and go, but strong companies endure, and owning a piece of those companies at a discount is a time-tested path to growing wealth. Whether you buy all at once or dollar-cost average in, this period of uncertainty might be the opportunity you've been waiting for, if you're prepared to stay calm, be patient, and execute your strategy with discipline. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.